If you've ever created an account on SSA.gov, you probably received this email from the Social Security Administration last week. One excerpt from the email says, quote, "The new law includes a provision that eliminates federal income taxes on Social Security benefits for most beneficiaries. And since President Trump has long said that taxes would be completely eliminated on Social Security benefits, this led a lot of people to believe that this was now the case, but unfortunately that's not quite true. However, there are changes in the tax law that will indirectly affect how much taxes you owe on Social Security benefits. So in this video, we're going to clarify exactly what those are and what they mean for you. First, if we haven't met, my name is Jake. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. I help people across the country retire with confidence and clarity. If you enjoy this video or learn anything from it, do me a favor and share it with a friend or leave a comment below. So what actually changed for seniors under the One Big Beautiful Bill Act is that now there's something called an enhanced senior deduction, otherwise called a senior bonus, which is an additional $6,000 per taxpayer over age 65 that you can deduct from your income. And this is whether you use a standard deduction or you itemize your deductions. This senior bonus deduction gradually phases out for single tax filers earning between $75,000 and $175,000. And for married filing jointly taxpayers, the phase out range is $150,000 to $250,000 of modified adjusted gross income. So once again, that means if you earn under that threshold, you get to use the full $6,000. If you earn somewhere in the middle of that range, you can use a partial amount of that deduction. And if you earn over that top threshold, you cannot use the $6,000 senior bonus deduction at all. So while this senior bonus deduction does indirectly reduce the taxes that you'll owe on Social Security benefits, it also reduces the taxes that you'll owe on any other sort of income. So it's not quite the same as Social Security being tax-free across the board. And let me explain why. The amount of your Social Security benefit that is subject to taxes is determined by what's called your provisional income, or otherwise known as your combined income. And the formula for this is your adjusted gross income, which would include things like IRA and 401k withdrawals, pensions, or any business or employment income, plus any non-taxable interest, which would come from municipal bonds in most cases. And then you add half of your Social Security benefit. So let's say that you and your spouse are both over age 65, and you withdraw a combined $50,000 from your IRAs each year. You also each receive $2,000 per month in Social Security benefits for a total of $48,000 per year. And we'll just say that you don't have any non-taxable interest. In this example, your provisional income would be $74,000, which is that $50,000 of your IRA withdrawals, plus half of your Social Security benefit, which comes out to $24,000. From there, there's 3 provisional income brackets that will help determine how much of your benefit is subject to taxes at your ordinary income tax rate. And the way that you would use this chart here is by taking your provisional income and starting to fill up each bracket. So you take the first $32,000 multiplied by 0% is 0. You take the next $12,000 that falls into this bracket, multiplied by 50% is $6,000. And then you add on the amount over $44,000, which is $30,000 in our example, and you multiply that by 85% to get $25,500, which means a total of $31,500 of their Social Security benefit is going to be subject to income taxes. So if taxes on Social Security were eliminated completely under the One Big Beautiful Bill Act, this provisional tax bracket system would be completely wiped out, which is not the case. It still exists. It will still exist this year, next year, and the year after. So to see how this enhanced senior deduction comes into play, let's compare the total tax bill, both pre and post One Big Beautiful Bill Act, in our tax planning software. So here we have a scenario analysis using our tax software that has both the pre One Big Beautiful Bill Act tax code and the new tax code here on the right. In both scenarios, again, they withdrew $50,000 from their traditional IRAs. And again, we're keeping it really simple by not including any municipal bond interest, no interest from any bond funds or high yield savings accounts, and no qualified dividends. So just those IRA withdrawals. And again, in both scenarios, they each have a Social Security benefit of $2,000 per month, which comes out to $48,000 per year. So again, under both tax laws or both tax codes, their taxable Social Security is still $31,500, and that's determined by their provisional income. So in both situations, their total adjusted gross income is $81,500. That's their taxable Social Security plus their IRA distributions. Now, what changes this year is the standard deduction. So under the pre-One Big Beautiful Bill Act, the standard deduction was $30,000 plus an additional $1,600 per taxpayer over age 65, which would have came out to $33,200. Now the standard deduction is $31,500. We're still keeping that extra $1,600 per taxpayer over 65. You also get an additional $1,600 if you're blind as well. But the senior bonus deduction is what we get down here that we don't see in the pre One Big Beautiful Bill Act. So this is that extra $6,000 per taxpayer over 65, whether you take the standard deduction or you itemize. So again, this is completely new, completely separate from the standard deduction. So what that does is it reduces their total taxable income down to $34,800 rather than $48,000 like it was before. So overall, their tax bill before would have been $5,319. Now it's only about $3,700 or so, for a difference of about $1,700. And just for comparison's sake, if taxes were completely eliminated on Social Security in this third scenario here, let's say that we use the same tax code pre July 4th of this year, the only thing that would show up on their tax return would be their $50,000 IRA withdrawals. Their taxable Social Security would show as zero, of course. And let's say that they don't get that extra senior bonus deduction, so they keep the same $33,200 standard deduction that they would have had earlier this year. No extra deduction. Their total tax bill would be about $1,700 versus $3,700 like it will be under the new bill. So while the enhanced senior deduction will definitely reduce taxes for any retiree receiving Social Security benefits, it's not quite the same as Social Security benefits now being completely tax-free. And if you haven't claimed Social Security benefits just yet and you're wondering the best time to do so based on your unique situation, I've made several other videos on the topic that you can check out by watching any of the videos in this playlist here. Thanks for watching. Subscribe to the channel if you enjoy this video, and we will see you in the next one.